My father-in-law, Robert, owns gold coins. He keeps them in a fireproof safe in his garage, next to his toolbox and a broken lawnmower he has been meaning to fix since 2019. I own Bitcoin ETFs. We have had this exact argument at every single family dinner since 2021. Christmas, Thanksgiving, his birthday, my birthday, last Easter, we almost ruined the ham. Today, I am settling it with math, not my opinion, not Robert's opinion, the actual numbers, what each asset actually returned, what it actually cost to hold it, what it actually did when markets got scary. And at the end, I am going to give you my honest answer about what I personally own and why. Robert, if you are watching this, and I know you are, I love you. But the math is the math, and the math is interesting. My name is Donald Cash. Double chin, gold tie. A dog named Jerome who has no opinion on monetary policy, but does have strong opinions about squirrels. I have been investing for passive income for 3 years. I have made expensive mistakes. I share everything, including the times I was wrong, because I think that is more useful than pretending I have a perfect track record. Today, Bitcoin versus gold. The real math. Let me be upfront about what this video is and is not. This is a comparison of historical performance, volatility, correlation to other assets, and practical considerations for an investor in the 45 to 65 age range. This is not financial advice. I am not telling you to buy either of these things. I am showing you the data and telling you what I personally do with it. And I am going to try very hard to be fair to both sides, because right now in May 2026, both of these assets are doing something very interesting, and they are doing it in completely different directions. Let us start with where we are today. Right now, this week, gold, as of early May 2026, gold is trading around $4,600 per ounce. Let me say that number again, $4,600 per ounce. A year ago, gold was around $3,200. That is a 44% gain in 12 months. And that is after a significant pullback. Because earlier this year, on the 28th of January 2026, gold hit an all-time record high of $5,602 per ounce. $5,600 for 1 ounce of gold. Robert, when I tell you this, I want you to know that I am saying it with genuine respect. Your garage safe is not looking crazy right now. What drove this? The same things that always drive gold. Geopolitical tension, the US-Iran conflict and the near closure of the Strait of Hormuz, a weakening dollar, central banks buying gold at elevated rates, and persistent inflation concerns that are keeping the Federal Reserve from cutting rates. According to the World Gold Council, global gold demand hit a record $193 billion in Q1 2026. Bar and coin demand alone was 474 tons, the second highest quarterly figure ever recorded. People are not just buying gold, they are buying gold in historic quantities. Now, Bitcoin. Bitcoin right now is trading around $76,000. A year ago, Bitcoin was around $94,000. That is a 20% decline in 12 months. From its recent high of approximately $109,000 in late 2025, Bitcoin is currently down roughly 30%. Bitcoin spent most of April 2026 consolidating between $75,000 and $80,000. It closed April up about 13% for the month, after bouncing from lows near $68,000 in early April. So right now, in this specific moment, gold is near all-time highs and Bitcoin is in a drawdown, which makes this an interesting time to have this conversation, because the story is not as simple as the recent price action suggests. Let me take you back 10 years, because that is where the real math lives. January 2015 to early 2025, 10 years. Gold in January 2015, approximately $1,172 per ounce. Gold in January 2025, approximately $2,700 per ounce. Total return, approximately 130% over 10 years. Annualized return, approximately 8.7% per year. That is good, genuinely good. And I want to give you context on that number. This 10-year return is actually below what gold has been doing since 2025. The big move happened late, gold at 4,600 today. Much of that gain happened in 2025 and early 2026. The previous 10 years were solid, but not spectacular. Over the very long term, from 1,971, when gold became freely traded, to 2024, gold has averaged approximately 7.9% annually. Good, not as good as stocks, historically, but good now. The same $1,000 in Bitcoin in January 2015. Bitcoin was trading at approximately $314. By September 2025, Bitcoin was trading at approximately $108,000. Your $1,000 became approximately $344,000. Total return, 34,300%. Annualized return, approximately 72% per year. I want to let that sit for a moment. Gold, approximately 130% over 10 years. Bitcoin, approximately 34,300% over the same 10 years. Now, I want to be completely honest about something, because if I do not say this, I am not being fair. These numbers use January 2015 as the starting point. That is one of the most favorable possible entry points for Bitcoin. If you had started in December 2017, right at Bitcoin's first major peak of around $20,000, by December 2018, you had approximately $3,000, down 85% in 12 months. If you had started in November 2021 at $69,000, by November 2022, you had approximately $15,000, down 77%. If you started in late 2025 at the peak near $109,000, you are currently sitting on a 30% loss. The 10-year number is real, but it required buying at almost any point other than the peaks, and then holding through multiple catastrophic-looking drawdowns without selling, which is much harder than it sounds. Now, what those Bitcoin returns actually cost you. Bitcoin's annualized volatility right now, approximately 52% per year. Gold's annualized volatility, approximately 15.5% per year. What does that mean in practice? It means Bitcoin regularly drops 50, 60, 70, 80% from its peaks, and then recovers, and then sets new highs, and then drops again. The specific major drawdowns, 2017 to 2018, Bitcoin dropped 83%, from roughly 20,000 to approximately 3,000, 2021 to 2022. Bitcoin dropped 77%, from approximately 69,000 to approximately 15,000. 2025 to current, Bitcoin dropped from approximately 109,000 to approximately 68,000 at the April 2026 low, roughly 38%. Each time, Bitcoin recovered. Each time, the recovery eventually created new all-time highs. But here is the honest question. If you are 55 years old, if you have $300,000 you have worked your entire life to accumulate, can you watch that number become $186,000 and not sell? Can you watch it become $200,000 and not sell? Because if you sold during any of those drawdowns, you did not get the 34,000% return. You got a loss. The return only exists if you held through every single one of those crashes without selling for years. How many people actually did that? Very few. Gold does not do that to you. Gold's worst recent drawdown, from the January 2026 peak of $5,600 to the current $4,600 range, about 18%. Uncomfortable, but not 80%, 18. And even with that pullback, gold is still up 40+% from a year ago. In 2008, gold's internal drawdown peaked at about 30%. But if you held gold as a full calendar year position in 2008, you ended the year roughly flat. The drop happened and mostly recovered within a single year. Then gold went on to gain approximately 170% over the next 3 years as the Fed printed money. This is the correlation difference that matters enormously for a retirement portfolio. Bitcoin's correlation to the S&P 500 has historically run around 0.6 to 0.7, moving in the same direction as stocks. When markets sell off, Bitcoin often sells off too. But here is an important update. In April and May 2026, Bitcoin's correlation to the S&P 500 has dropped to approximately 0.2. Is less than BR, is greater than. Some analysts are pointing to this as a structural shift. Bitcoin is beginning to behave less like a tech stock and more like an independent asset class. Whether this is permanent, nobody knows yet, but the direction is meaningful. Gold's correlation to the S&P 500, approximately negative 0.1 to 0.2. Gold tends to move independently of stocks, sometimes up when stocks go down. In early 2026, when the Iran conflict escalated and global markets got nervous, gold surged. Bitcoin was volatile, but showed more independence from the equity sell-off than it historically has. The assets are converging in some ways, but they are still fundamentally different. Let me talk about what each asset actually is. Gold has been a store of value for approximately 5,000 years, not because someone decided it should be, because it has specific properties: scarce, durable, chemically stable, impossible to create from a printing press, recognized across every culture on Earth. Central banks hold gold. Right now, central banks bought 244 tons in Q1 2026 alone. The Bank of China, the Federal Reserve, the Bundesbank, India's Reserve Bank. When the world's largest institutions need a store of value that does not depend on any single government, they buy gold. That has been true for 5,000 years. I want to give one piece of honest context about the 1970s, often cited as gold's inflation-fighting record. In 1971, Nixon ended the dollar's convertibility to gold, which had artificially held the price at $35 per ounce for decades. Some of that decade's surge was gold finding its real market price after being suppressed for years. The inflation hedge thesis holds, but the magnitude includes a one-time repricing event that cannot repeat. Bitcoin is different. Bitcoin has been a credible store of value for approximately 15 years. Its scarcity is mathematical. There will never be more than 21 million Bitcoin. That limit is hard-coded. No government, no company, no individual can change it. Since spot Bitcoin ETFs were approved in January 2024, institutional adoption has accelerated dramatically. BlackRock's IBIT now holds approximately 812,000 Bitcoin, worth roughly $62 billion. That is 62% of the entire Bitcoin ETF market by assets under management. In April 2026 alone, US spot Bitcoin ETFs saw $2.44 billion in net inflows, the strongest institutional month since October 2025. 75% of institutional investors polled by Coinbase in April 2026 rated Bitcoin as undervalued at current prices. Bitcoin's market cap sits at approximately $1.3 to $1.5 trillion depending on current price. Not $2 trillion as at its peak, but still a serious institutional scale asset. 15 years of growing institutional acceptance versus 5,000 years of gold. Robert's fireproof safe is not irrational. Now, let me talk about something most Bitcoin versus gold comparisons skip entirely: taxes. In the United States, physical gold and most gold ETFs are classified as collectibles for tax purposes. The maximum capital gains rate on collectibles is 28%. Bitcoin ETFs are taxed as regular capital gains, 15 to 20% for most people. Same gain, different tax treatment. On a $100,000 profit from gold ETFs, your maximum tax bill is $28,000. On a $100,000 profit from a Bitcoin ETF, $15,000 to $20,000. That 8 percentage point difference is $8,000 on that example. On real money, it is a real number. Check the specific fund structure. GLD is a collectibles trust. Some gold ETFs have different structures. Verify with a tax advisor for your specific situation. I am not a tax advisor. I am a man with a double chin and a gold tie. But I read the fine print, so you do not have to ignore it. Let me now address what these assets do in specific economic scenarios. because this is where the strategic difference becomes clearest. Scenario 1. High inflation and geopolitical stress. This is the current scenario. May 2026. The Iran conflict. The near closure of the Strait of Hormuz. Persistent inflation keeping the Fed from cutting rates. The Federal Reserve just held rates steady. 4 officials dissented, signaling deep divisions over policy. Gold's response surged to $5,600 in January, currently around $4,600 after some profit-taking. Still up 44% from a year ago. Bitcoin's response, volatile, down from its peak, but showing increasing independence from the equity sell-off compared to its historical behavior. Advantage in this specific current scenario, gold, clearly and decisively. Scenario 2. Monetary expansion and risk appetite. When the Fed was printing money and rates were near zero, Bitcoin was up 1,400% in 2020 to 2021. Gold was up 25%. No contest in that environment. When institutional money is hungry for growth assets and liquidity is abundant, Bitcoin dramatically outperforms gold. Advantage when conditions are favorable. Bitcoin decisively. Scenario 3. Normal economic growth. Bitcoin outperforms. Gold holds its value. Neither argument is wrong for its time horizon. The question is, which scenario do you think the next 5 to 10 years looks like? More geopolitical stress and inflation? Gold. Return to monetary expansion and risk appetite? Bitcoin. Nobody knows. And that is actually an argument for owning both. Here is my honest synthesis of what the data shows. Gold right now is having its moment. $5,600 all-time high in January. $4,600 today after a healthy pullback. 44% up year over year. Central banks buying at record rates. Geopolitical crises driving flight to safety. Robert's gold coins in the garage have made him a lot of money over the last 2 years. Bitcoin is in a drawdown, 68,000 at the April low, now recovering towards 76 to 80,000. Institutional money is buying 2.44 billion in April ETF inflows. But price is down from the 2025 peak. Over 10 years, Bitcoin still wins the pure return comparison by an enormous margin. But the experience of holding Bitcoin during its drawdowns is genuinely brutal. And the experience of holding gold during a geopolitical crisis is genuinely reassuring. They are not competing for the same role. Gold is a defensive asset. Crisis protection. Inflation hedge. 5,000 years of proof. Bitcoin is an offensive asset. Extraordinary growth potential in favorable conditions requires stomach for massive volatility. 15 years of proof with accelerating institutional structure. Asking which one will make you more money is the wrong question. The right question is, which scenario is your financial life most exposed to, and which asset protects or grows you in that scenario? So what do I actually own? I have approximately 5% of my total invested portfolio in Bitcoin through IBIT, the BlackRock ETF. No hardware wallet, no private keys, no garage. Why 5% specifically? Here is the math I use. If Bitcoin drops 80%, which it has done before, my 5% position becomes approximately 1% of my portfolio. Uncomfortable. Not portfolio ending. My dividend income keeps coming. My REITs keep paying rent. My T-bills mature on schedule. If Bitcoin doubles from current levels also within its historical pattern from drawdown recoveries, my 5% position becomes approximately 10%. At that point, I trim back to 5. Take some profit. Rebalance. For someone within 3 to 5 years of retirement, 1 to 3% maximum. Sequence of returns risk makes a large, volatile position genuinely dangerous that close to the drawdown phase. For someone with stable income and a longer horizon, 5% feels right for me personally. That framework is mine. Your number depends on your situation. I also own approximately 3% in gold ETF. I use IAU, specifically lower expense ratio than GLD, around 0.2% annually. And I am aware that it carries the collectibles tax treatment when I eventually sell. Not as a growth asset, as insurance. The thing that goes up when everything else I own is going down simultaneously. which is exactly what it did when the Iran conflict escalated earlier this year. Together, 8% in alternative, stores of value, Bitcoin for growth potential, gold for crisis protection. The other 92%, dividend ETFs, REITs, short-term treasuries, generating income every quarter, whether Bitcoin is at 76,000 or 120,000. Robert's position, as of our last conversation, he still has the gold coins. He is not selling them. After the January 2026 run to $5,600 per ounce, he is feeling very good about himself. He mentioned it 4 times over Easter dinner this year. I did not ruin the ham. But he also still has that small Bitcoin ETF position he opened last year, about 2% of his savings. It is down from where he bought it. He is not panicking. He is checking it less often now. I told him, that is progress. He said, I closed the app like you told me to. I said, and? He said, and I am still checking it on my laptop instead. Robert is learning. Here is the 1-sentence answer to the video title. Over the last 10 years, Bitcoin made dramatically more money than gold if you bought at a reasonable price, held through multiple 80% crashes, and never sold. Right now, in May 2026, gold is having the better year. Both answers are true, at different time horizons, for different investors, in different economic environments. The asset you can actually hold through a crisis beats the asset that theoretically performs better but that you sell at the bottom. Which one can you hold? That is the real math. Jerome has no opinion on any of this. He does not own gold. He does not own Bitcoin. He owns his spot on the couch and what appears to be a tennis ball that belongs to nobody in this house. Jerome is diversified in his own way. My tie is still tight. And the portfolio is still working. All 8% of it in alternative stores of value. All 92% of it generating income. Let the money do the work. In the comments, are you Team Gold, Team Bitcoin, or Team both right now? Tell me your allocation if you have one. And tell me whether your family dinners have ever been almost ruined by this debate. I reply to every comment. Donald Cash, out.